from the University of Otago in New Zealand. It's my pleasure to chair the session today. We have a very interesting panel that's going to speak to us about the European audit regulations and the changes that's coming. I think what's unique about this panel is that they have real-life experience, and what we're hoping for, I guess, from an academic perspective is to understand some of the challenges that are being faced in this space and perhaps look at some of the research opportunities that might evolve from there. So I just want to introduce you to the panel members. Just to my right is Jeremy Jennings. He's a former Anderson partner and also was, till recently, the head of EY's Regulatory and Public Policy. And what this means is that every major crisis which has occurred in the recent time, Jeremy has had a major role in that. And so we are helping solve that. Sorry, Jeremy.
You qualified that.
And so this gives us a very deep insight into, or will give us a very deep insight into what actually were the real issues from a CA perspective. Next to Jeremy is Marek Grabowski, and he's the Director of Audit Policy at the FRC, and he's also a previous partner at PwC, and he's on the board of the IAASB. And so again, we have from this time at the moment a regulatory insight that we'll be able to get, and so we're looking forward to hearing Marat's. Next to Marat is Mark Schiffer, and he's the CEO of Audit Analytics. And Audit Analytics started in the United States collecting audit and governance data, and this has allowed many of the researchers in this room to do some very insightful work in the audit space, and increasingly they are moving into other jurisdictions, including Europe, and so Mark has also a very deep understanding of ethics and accounting, and so we look forward to Mark's contribution. And then at the far end of the table is Anya Brewer, and he's a PwC partner, chief accountant, and he's also a professor of external reporting at VU Amsterdam, and so he brings to the table the ability to speak to academics in our language, plus also understand what the challenges are in the profession. So it's a great pleasure to have you all here, gentlemen, and we look forward to your contribution. What we're going to do is each person is going to speak for around 15 to 20 minutes, and then we'll have a Q&A. And the first person up is Jeremy. So Jeremy, the floor is yours.
Thank you. If I may, I'm going to go over there. I'd like to be able to sort of walk around a little bit. I should have to say closer to the microphone.
Firstly, it's a great... Oh, wow, that's different. It's a great pleasure to be here. I have to say that I'm slightly intimidated because I've attended a number of your sessions over the last few days. I'm not an academic, and it felt a bit like having landed on the planet Zog, because you guys, you talk a completely different language with formulas and stuff, and I'm really, you know, I feel kind of humble, surrounded by this academic excellence. So what I'm not going to do, I'm not going to give you a thesis on the extended audit report. I'm going to give you some context around the EU audit legislation, from which the extended audit report is one of many, many new requirements. I'm going to leave the real academics over there to talk to you about the nuts and bolts of the audit report. So what I'm going to do is I'm going to tell you a story, which is why I don't have any slides, okay? And chapter 1 actually begins with Marek Grabowski, because I met Marek for the first time in 1993, when Marek was at Pricewaterhouse and I was at Arthur Andersen. And with the assistance of a partner from Coopers & Lybrand, we worked with Maastricht University on a study for the European Commission called The Role, the Position and the Liability of the Statutory Auditor in the European Union. And in fact, the project leader at that time was Stephen Mayor, who is now the chairman of the European Securities Markets Authority, so he's done rather well. And I think there are other people from Maastricht who are actually here today with us. That study was the forerunner of legislation. We had a green paper consultation, we had a white paper consultation, and then on the 17th of March 2004, we had a proposal coming out of the European Commission for a modified 8th directive, which became the statutory audit directive, ultimately of 2006. It was adopted in June 2006, due to be implemented by June 2008. Now, every directive in Europe has to be implemented by the member states. It was minimum harmonisation, and with all directives there were more member state options than there are holes in a Swiss cheese. That's just the way we do business in Brussels. It was a good piece of work. It was a good piece of legislation, both the process and the end product, and it was a very, very real reform of the audit profession. First of all, it introduced for the first time independent auditor oversight across the European Union. It introduced mandatory audit committees for public interest entities and introduced the PIE definition, which is unchanged to this very day. A PIE company with shares or securities admitted to trading on a regulated market in the EU, private banks, private insurance companies, and inevitably the ubiquitous member state option to expand the definition of a PIE if it makes you feel good. And in fact, back in those days, many, many, many member states, in fact a majority of member states, expanded the definition. Spain, for example, they decided that any company with turnover greater than 200 million euros was a PIE. And at one stage, Spain had 9,000 PIEs out of a population of around about 35,000. It also introduced stricter requirements on independence. Okay, a principles-based approach, but nonetheless a very robust approach to independence. So it was a good piece of legislation. Was it the European response to Sarbanes-Oxley? Well, yeah, to some extent. But bearing in mind, Marek and I started working on this in 1993, actually the roots of that legislation were things like BCCI, Maxwell Corporation, Polypec, the Schneider Group in Germany, and more recently, Parmalat. But it was a good piece of legislation. Even by 2010, there were still member states that had not yet fully implemented that piece of legislation. And of course, along came the financial crisis. Now, we all know that in 2007, we had the subprime crisis, but for me personally, the financial crisis started at 6:30 p.m. on Sunday, the 14th of September, 2008. I was in Times Square in New York. Inevitably, there was a meeting of the global CEOs the next day. We often had meetings on a Monday morning in New York, which meant that all our European colleagues had to fly over on a Sunday. And I was there in Times Square, and there was a little bit of a hubbub. There was a police presence. And there was a stream of people coming out of this building carrying cardboard boxes, and many of them, men and women, were in tears. And I thought, wow, you know, what's going on? And I took a step back, which was quite brave, because in those days Times Square was not a pedestrian precinct, and indeed I saw that they were coming out of the building of Lehman Brothers. And indeed on the 15th of September 2008, as we all know, Lehman filed for bankruptcy. And that, for me, personally speaking at least, was the beginning of the crisis. Now, if I look back at those days, actually the initial debate in Europe was not about auditing at all. It was about accounting, and the fact that the accounting standards were being seen as pro-cyclical because they were forcing companies to have to write down these exotic financial statement interests in their balance sheets. In fact, the firms collectively brought together with the European Commission and the audit regulators and other interested stakeholders to discuss what we could do to better respond to the concerns coming out of the crisis, because we didn't want to be in a situation where we were having to qualify the financial statements of all the large PIEs in the European Union. And I can remember at that time Paul Boyle, who was then the head of the FRC, saying that in his view the profession had had a good financial crisis. And indeed that sentiment was echoed by a report prepared by René Ricol for President Sarkozy in September of 2008, where he basically concluded that indeed the profession had played a positive role in facilitating to address the concerns about the crisis. But all that changed when the former Commissioner Charlie McCreevy, who was a very benevolent, benign character, returned to his horses in Ireland, and he was replaced by the French Commissioner Michel Barnier. Michel Barnier came in the sort of early part of 2010, and I was reflecting on this only yesterday because if you think back to the timetable for the original 2006 directive, it took 11 years between Marek and I working on that study with Mark to the proposal being adopted by the Commission on the 17th of March 2004. That's 11 years. The 2014 regulation and directive was basically drafted and put in place within 12 months. And it made me think that actually, I think maybe Monsieur Barnier had already mapped out in his own mind what he was going to do with the profession. He had a hypothesis about the financial crisis and the role of audit, and it's a hypothesis that is worthy of academic scrutiny because, in my view, it has not yet been subjected to the rigor that you can bring to the policy debate. And his hypothesis was quite simple. During the crisis, there were 400 banks that received unqualified audit reports, and yet within a matter of 3 to 6 months, those very same banks were going cap in hand to their governments to be bailed out with taxpayers' money. And the accusation was, why did the auditors not raise a red flag? Why did we not qualify those financial statements to say, hey guys, we're not sure that HSBC is a going concern? Now, of course, you can sit here and say, well, hang on, if we had done that, would the crisis have been any better? I think actually the crisis might have been a lot worse, but that's a separate issue. But the accusation was that somehow there was something systemically wrong with the audit profession. And those 400 banks became the proxy for regulatory activity for 35,000 public interest entities. The accusation was that actually we were not independent. Why were we not independent? Well, we've been doing certain audits for 100 years. How can you be independent when you've been doing the audit for such a long time? Clearly, the relationship between the firms and our clients was too cozy. In addition, the accusation was we only ever do an audit to sell non-audit services, which clearly could impair our independence. Thirdly, he said, well, the market is dominated by an oligopoly of the Big Four. The Big Four audit 75% of all listed companies in the European Union. There is clearly collusion, there is clearly price fixing, there is clearly a whole range of naughty activities going on, and we need to do something to address that problem. There is a lack of innovation, there is complacency amongst the Big Four, and of course there were inspection reports from some of the audit regulators which were saying that some of the audits performed by Big Four firms were of lesser quality than they should have been. So that was the hypothesis. Now, when you consider what the solution was, you firstly have to look at Monsieur Barnier himself, because he is a classic Gaullist politician, which means that essentially if it's small business, it's good. If it's big business, it's not so good. And if it's American big business, it's even worse. Okay? That's the basic mentality. Now, something that just underscores that is some comments made about Lehman, because when Lehman went down, there was a report by Mr. Valukas, the banking examiner, huge thing, and in it was identified the Repo 105 transactions that Lehman had undertaken, the essence of which was to try on a quarterly basis to smooth the leveraging numbers in the financial statements. It was all very transparent, all disclosed in the notes, but it was all off balance sheet. And Monsieur Barnier said that actually Lehman Brothers gave further justification for the need to reform audit in Europe. The irony of that is actually those repo transactions were undertaken by Lehman International in the United Kingdom, and they were all on balance sheet in accordance with IFRS. So actually this was not a debate about audit. It was really a debate about whether the Americans might want to address and adopt IFRS rather than having US GAAP, but that's very political. The last thing, of course, though, was I believe that the goal was actually to try and manipulate the market. It was to try and change this Big Four oligopoly, but the problem was that the competition commissioner at the time, Mr. José Almunia, a Spanish man, was saying that actually the only reason that the European Commission could intervene in that marketplace was if there was evidence that the Big Four were abusing a dominant position. Now, no one would question that they were big, but there was no evidence, absolutely no evidence of any collusion or price fixing or anything like that, no cartel behavior. And so DG Competition said, sorry, there is no basis upon which we could intervene in this market. But the Commission were very smart, because in fact what they did was say that this reform was about the pursuit of absolute quality, absolute independence, sorry. And in fact, if you look at some of the text that came out of the Commission, absolute independence was what they were talking about. In the belief, I guess, that absolute independence gives rise to absolute superb audit quality, which gives rise to absolute assurance in the quality of financial reporting in the European capital markets. Now, I think that's like looking for the pot of gold at the end of the rainbow, to be honest with you, but that was how it was all dressed up. So the solutions were actually positioned as independence related. So in fact, the idea of having mandatory firm rotation was positioned as breaking up the cosy relationships, not trying to open up the market to enable smaller firms to compete for audits of big companies. The original Commission proposals had mandatory joint audit for all large PIEs, where you would have not one but two auditors, of course, a Big Four plus a firm who had less than 15% of its revenues coming from the audits of PIEs. We had complete bans pretty much on the provision of non-audit services and the expectation that that would enable other firms to provide those services. And then lastly, if that wasn't enough, we had the idea of actually reversing some of the consolidation in the sector by creating audit-only firms in some markets and in some countries. That would have meant that a Big Four firm would have to divest itself of its tax work, its consulting work, its advisory work, and only do audits, only have audit personnel. Now, the legislative process was such that audit only went. In fact, it was the College of Commissioners that removed the requirement for a mandatory joint audit. They didn't like the idea that Mr. Barnier was trying to export the French model to the rest of the European Union. But we've ended up with a piece of legislation which is a little bit like the curate's egg. Now, there are some of you who are familiar with the curate's egg, perhaps some of you aren't, but actually that goes back to a cartoon that appeared in the British satirical magazine Punch in 1895. It was actually penned by a gentleman called Georges du Maurier, and it depicts a bishop having breakfast with his curate, Mr. Jones, and the bishop looks at the egg on Mr. Jones's plate and says, "I say, Mr. Jones, it looks like you've got a rotten egg there." And Mr. Jones, desperate to say something positive, says, "Oh, no, 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 my lord, I assure you, it is excellent in parts." So it is with the audit legislation. There are bits of it that are excellent, and the extended audit report is one of those bits. I'm not going to give the Commission all the credit for that, because the original proposals were very much modelled on what was going on in the United States, what was going on at the international level. The European Commission tried to improve that by adding some interesting requirements. Number one, the audit report should be no longer than 10,000 characters, including spaces. That's harmonisation for you. The second was that the audit firm had to name every member of the audit engagement team in the audit report. My friends at PwC politely pointed out that on the audit of Barclays Bank, if they were to list every member of the audit team, they would actually need more than 10,000 characters plus spaces. Now, those two requirements were defeated as part of the legislative process. There was another one, and I think this reflects the mentality of the gentleman who did the drafting in the Commission. He was actually a UK chartered accountant from a very, very small firm in the west of London. I'm not sure he'd done any very big audits, but it was the pursuit of going back to basics, basically tick and bash. And there was a requirement to state in the audit report the percentage of assets that you have substantively tested and verified, as opposed to those assets that you've valued or done compliance testing on or whatever. That was also deleted. So we are left with the extended audit report is a significant move forward. I think really now it's the time to let you have the real experts talk to you about the extended audit report. There are some problems with it, but we may come back to that in the Q&A. Thank you very much indeed.
Thank you, and good morning. I'm not going to wave my hands around from up there, if that's okay. Only because I don't do it as well as Jeremy does. And I'm going to try and talk to you fairly quickly, actually, because there's quite a lot of stuff we could cover, about a couple of things. The first is I'm going to give you a quick canter through the requirements that the IAASB has issued, what we were trying to achieve around extended auditor reporting. Then I'm going to tell you a little bit about our experience in the UK. We, as we'll see, started our process going a little earlier. But I couldn't help but pick up on something that Jeremy said in what he was talking about. And maybe the auditing profession did have a good crisis. I don't know if that's right or not, and quite what was meant. But I thought the House of Lords Economic Affairs Committee really summed up the issue pretty well. They said, well, if auditors, I'm pressing, but if auditors did everything they should have done and did it well, what was the point of an audit? So it's an interesting place to start. And actually is the place that all of the reforms around extended audit reporting do start. It's all about trying to engender justified confidence in the quality of the audit. And quality of the audit and that confidence in it is not an end in itself. It is simply a route to confidence, justified confidence in corporate reporting. One of the things that was of concern, certainly to those of us who were trying to consider this question of confidence, was the connection between the auditor and their true client, not necessarily the client as they would use that word, but the true client, the user of their audit report and of the financial statements. In the end of the day, the auditor's reports are communication, and really apart from regulation interventions through inspection or investigations, that's really the only window that users have into what the auditor does. And that is the only basis, therefore, on which they can build confidence and trust in what the auditor does. What does quality mean in that sense? Quality really means at least has two aspects. The first is performance. Did they do an effective job in identifying misstatements and dealing with them? But the second thing is really, did they do an ethical job? And that has many dimensions. But a really key part of that is, did they understand where their responsibilities lay in terms of the interests they were serving, and did they manage to avoid conflicts of interest? So these two things are very bound up, and one of the things that makes it difficult to talk about any of the reforms post-crisis is if you talk about any one, you fail to make the connections with all of the others. I think that's a point I would like to just make before we carry on and then spend most of the time on one. Okay, so investors told us what about the audit report? They told us that it wasn't very interesting. They liked the binary opinion. They read that, and anything else in the report was really of no interest to them. It wasn't relevant, it was boilerplate. And so we wanted essentially to enhance that relevancy of the auditor's report for users and to provide communicative value. Going the wrong way. So how could we do that? Essentially, we wanted to ensure that the audit was made more transparent, a word that is often used and is really at the heart of what we were trying to do. Various things, as you can see on this slide, that I would describe as exogenous benefits, clarify and improve the user's understanding of the audit through not only the report is a starting point, but really it was seen as a starting point for engagement between users and auditors, not necessarily on a particular audit, but to better understand the purpose and role of an audit. clarify questions around scope, that question that the House of Lords Economic Affairs Committee asked. So what should the auditor be doing in the view of users, and how do we reconcile those gaps? Providing the auditor's insight, the auditor's perspective, if you like, on key risk areas and related disclosures in the financial statements. But there's also an endogenous benefit to these reforms, we believe. The very fact that the auditor has to talk about more than simply the underlying final opinion that they produce, we think will also make them focus more on what they're doing in order to address those issues that they report on. And that has benefits because it means they'll engage more on those things internally with the audit committee. They'll focus more internally in their teams. They will give more partner attention to those matters. And through that, we believe that there is scope for improved professional skepticism and audit quality. This slide summarises the process really from about 2013 to now in terms of extended auditor reporting. And I won't dwell on it very much, but you can see there were a number of points along the way, ending up with the EU requirements coming together a year later than the IAASB requirements, and this is indeed the first year of those being reported on. You'll also see from this that we published our first requirements in the UK in 2013, and that means we've got 3 full cycles of EAR reporting behind us, and quite a rich set of material actually for research. The IAASB's CAMS and other reporting reforms came into effect therefore for 2016 year ends, so we're just at the end of that first year. The reforms, it's important to recognise, are not just about key audit matters, though it's a key part of what's been done, and I'll touch on some of those things shortly. I won't spend long on this slide. Key audit matters, matters of most significance in the audit. It doesn't say that that is purely risks, and it doesn't mean that that is purely risks. But obviously there's quite a strong correlation between matters and risks. The slide here shows a bit of a funnel, really just to show you how the auditor is supposed to think through the process. First of all, what did they communicate with those charged with governance? And to go with that, we enhanced communication requirements. Of those things which required significant auditor attention, things of course that related to the higher risk areas, things that involved significant auditor judgment, and other things that had a significant effect on the audit. And then finally, of those, selecting those that were of most significance and arriving at the end of the funnel. Which entities' audits were covered by this? In terms of the IAASB, defining a pie is a little bit like seeking the perfection that Jeremy talked about. Very difficult to do at an international level, and so the approach the IAASB took was to require it for listed entities and make it voluntary but accessible for other audits. And that meant that member states in around the world could, of the EU or elsewhere around the world could scope it as they saw fit. And then finally, there were documentation requirements really related to the judgments that the auditor was making through that funnel. Another brief but quick important point, what type of information makes a good communication in a key audit matter? What we were told by users was that they wanted relevance and usefulness over consistency and comparability in this area. In CAM, they wanted the scales to weigh in that direction. And that meant having entity-specific and audit-specific information, not boilerplate. I said I'd come back to this. This is really just a quick review of where else did the extended auditor reporting go beyond CAMS. You can see here that there was some work around the audit opinion positioning. It should be at the beginning of the report. This was really reflecting a thought that a good communication structures the information it provides to give the most important information the most prominence. But you'll see here also there are a number of other areas that were addressed. Going concern, much greater emphasis on going concern, an enhanced responsibility statement, that bit is boilerplate, but some requirements for auditors to stand back and look at disclosures in particular when there are close calls on going concern, and possibly to use a CAM in some of those sorts of situations. There was a lot of new work done on the rest of the annual report and the auditor's responsibilities, really introducing an enhanced work effort and explicit reporting in that area. And then generally an enhanced auditor responsibility statement. And following that concept of less prominence to the less significant information, recognizing that that could be signposted to on a regulator's website. On the whole, it's early days to say anything about what we're hearing about the experience from the IAASB standards per se, but from the experience not only in the UK but other early adopters, and you'll hear more of this later I'm sure from Arjan, these reforms have generally been widely welcomed. Change is always difficult to manage, and actually here I think effective implementation really need is early and mutually supportive engagement by many players, and that's a really key theme to making it successful in my view. A slide you probably can't read, but I'm hoping you get these to take away, I'm not sure. Really this is to move on to the UK experience, and you can see here that we published our first requirements in 2012 and 13. First year of reporting was 2014. Compare that with what the IAASB did in 2016 and what the EU Audit Regulation and Directive requirements were in 17. And there are some interesting points to draw out. I won't dwell on much of the detail, but some of the key points, if you look at the scope line at the top, in the UK, we were focused on companies, listed companies who were, we call them premium listed in the UK, who follow the UK Corporate Governance Code. And the reason for that was that we were integrating these audit requirements that we introduced, auditor reporting requirements, with a whole swathe of other governance type requirements that were linked to it. And I don't have time to go into those today. The IAASB explained the listed entity link, and Jeremy's explained the PIEs. When we have combined those, integrated them for our new 2017 standards, we've combined all three. And so any company that falls in any of those categories is really covered by the requirements. What else would I pick out? A key thing I would pick out is the line there that says materiality and the line that says audit scope. Key audit matters is common across all three of these areas. The two things that we introduced at the same time as key audit matters were materiality, which is the auditor's connection to the user ultimately, and audit scope, by which we meant explain how you addressed your application of materiality, the concept of materiality, to address the matters that you reported. The other one that's interesting really to point out is the going concern statement. The going concern statement really is restricted to when a material uncertainty exists. But in the UK, we have introduced a requirement for explicit reporting each year. That had been something that the IAASB proposed to do and pulled back from at the end, but is something that will be looked at again as the IAASB does its post-implementation review. In the other information area, again, really just to highlight that a lot of new work was done in this area. I described it briefly earlier, but there are some important differences in the EU audit regulation, which require actual opinions as opposed to exception reporting. In our own area, we have drawn out very particular things for exception reporting around some of the governance improvements that we introduced that I mentioned earlier. UK experience to date. Really just to mention that there are 2 reports for the first 2 years, therefore, of EAR in the UK, which we produced. The purpose of those reports was really to demonstrate what was happening in the marketplace and convey messages from investors to auditors and vice versa. In other words, what did they think about this stuff? Auditors, in fact, innovated quite significantly from the beginning and have continued to do that through the 3 years that we've seen so far. And by that I mean they did more than we asked them. Not in every area, but in some areas quite a lot. Obviously, auditor reports now provide significantly more, and from the point of view of an investor, better information. And the other thing that was very interesting was the investor response. It was somewhat managed, I have to say, because we wanted it to be a success, but investors were enthusiastic, including setting up an award for the best reports in the UK, which they ran for the first 2 years and will skip a year for the 3rd year and return to it on a biannual basis thereafter. I'll just pick out a couple of points off this slide, which picks up some of the more detail. Really, one that is constantly heard in the UK is the investors liked those reports that talked about the auditor's findings in relation to the matters reported, and they want more of that. I have to say it seems that auditors are a little reluctant to move further forward in this area, but we keep channeling that communication between them. Investors also want more information about accounting estimates. These 2 points are really related, but what ranges was the auditor comfortable with, and what were the results of their audit testing? And then finally, investors want more analysis of changes year on year. Why have things changed? Why are there issues? We saw some of that in the 2nd year. We haven't seen that move very much, but particularly of interest to investors. Then I just wanted to touch on our approach to the audit regulation and directive. Jeremy mentioned that this legislation was good in some places, bad in others, and this is very true, and generally in the auditor reporting area it's pretty good. However, there are still areas where frankly, it's impossible for anyone to have a clear and unambiguous view. So the two things that I would draw out here are, in order to get that consistent application internationally across member states, that is really only something that can happen through coordinated work at EU level. And the mechanism for that is the CEAOB, which is a body that brings together the audit regulators in Europe. We input to that based on UK experience, but without going into the details, what we do in the UK is bring together a group of stakeholders, not just auditors, not just audit committees, but also investors and others, to talk about the issues that auditors are finding some challenge in doing consistently or interpreting. And the result of that is that we generally find a consensus view is formed. Those conversations that we have are structured to focus on principles, and we publish the outcome of those on our website under this heading, Rolling Actions. And then in some limited areas where more guidance is needed from us, we've published staff guidance notes. But again, this is an area where there's quite a lot of information that you'll find about the issues that are, in practice, giving auditors difficulty in interpretation, and the views that we currently have. Finally, and I must stop. It looks like I'm running a little over, actually, so apologies. What did we learn from all of this? Many of the initial fears that many people had, it wasn't a completely smooth run in the UK, but there was general support. But the fears tended to be around things like disruption to reporting timetables, impact on audit fees. There were also concerns about auditors reporting things that the company didn't. But really there is little evidence that those were realised. And I'm not particularly surprised by that, because we set it up to ensure that companies and auditors and audit committees of companies worked together, shared common goals, had aligned responsibilities, and so worked together. We believe from the experience we've got so far that transparency can help drive up audit quality and build justified confidence. Obviously, it can be easily lost if the underlying work doesn't reflect what's said in the audit report. A very small example of that was in the first year. We found in a significant number of cases, sufficiently significant to warrant writing to the firms to point it out, that some auditors were writing what it seemed people might like to hear, or that they knew should have been done, but didn't always back that up in all respects by what they actually did. So there's a danger in that, obviously. The second or third thing perhaps that we draw from it is that in delivering innovation, the market's actually pretty good at responding where prescription might not. Entity-specific information is quite difficult to prescribe without having a very lengthy requirement. We managed our requirement in the UK across key audit matters, materiality and scope, with 3 requirement paragraphs and 3 application material paragraphs. Still the shortest piece of standard setting I've ever been involved in. But actually what happened as a result of that has been pretty extensive, and so that's an interesting read for us. But there is still unsatisfied demand from investors. This is a journey, as I said before, a much misused term, but that journey is at a relatively early stage, I think. Particularly the last point on this slide is true, that in terms of that journey, we still believe that extended auditor reports are stimulating better engagement with investors, but that really is quite at an early stage and still needs to happen far more. Many thanks.
Thank you so much for that. We'll just move on to the next speaker, and Mark, if you would like to take the podium, fantastic.
The first thing that I was wondering was, Jeremy, you're EY partner, and then we have 3 PwC guys, so I'm just wondering whether the table's a little bit heavier on this side, or... and I also wanted to just comment about Marek in terms of the FRC has been basically leading the regulatory charge in the area of a lot of this extended reporting for auditors, and it's kind of, you can see that other countries around the globe, the U.S. in particular, is kind of following at a sufficient distance so that Marek takes all the arrows. So the guy taking the arrows for this, you can see right here. Now I'm going to wear 2 hats in my presentation. The first one is just to give you some basic trends that we're identifying, having now started to collect what I consider to be nearly impossible data to collect in the EU. So we'll do that first. This is kind of the low impact part of the presentation. Then I'm going to do EARS, a slightly different EARS extended audit reports presentation. And we'll see how that goes. Okay, so, all right, what we're seeing right now in terms of EU listed companies, this is your breakdown across about 7,000 companies, I think, across the EU. This is your breakdown of the firms. You can see here that, if you can actually see that, PwC appears to be leading the way, but the other 3 firms have exactly the same percentage. So I thought that was kind of interesting. I don't know how the mandatory rotation is going to affect that, but the Global 6, in terms of LSE companies, obviously a lot more prominent. And in this case, KPMG jumps ahead of all the others, not by much, but by some. Have the auditor tenure information. Now, this is somewhat interesting just because this is for the FTSE 350. You can see here that well, I think there's probably only a couple companies with over 100 years of left. On the far right, you can kind of see that they've been obviously working on that, and the skew is in front. So Jeremy's discussion about you know, audit tenure and the effort of this particular commissioner, well, seems to be working. This is in comparison to the U.S. This is what it looks like in the U.S. And yes, there still are a few over 120 years, some relationships. And you can see that distribution is still in the, this is for the S&P 500, you can see that it's, so you can see a kind of, it's, you know, the U.S. and the EU have really have quite different positions on the tenure question. Audit fees versus non-audit fees. This is for each, basically each major market in the EU. The percentages range quite dramatically between countries. So this is information we've been, I guess, pulling out. We have here the, basically the pies, and I'm going to run through these slides quickly if you're interested. What they basically tell you is that figuring out who all the pies are in Europe is a difficult process. And you can start with the transparency reports, but that's not going to get you there. You can start with the listed companies, but a lot of them are not actually on the transparency reports, which I'm not sure why. And the difference, the difficulty is country to country. Here I have again the PIEs in the UK transparency reports. Again, some of them, not all of them, are in transparency reports. And transparency reports, if you're not aware, is the audit firm has to report their PIEs every year in their transparency report. You would think that this would be, for example, that top line, London Stock Exchange, population around 1,000, transparency report disclosure around 800. You would think that would be 1,000. I'm not quite sure why, but we'll figure it out. Again, more on the transparency reports. Okay, now I'm going to put on my other hat. And this is the one I think is a little bit more interesting. Most of you are aware of the whole question of extended audit reports and CAMs. Most of you are aware that we have CAMs with a K and CAMs with a C. The U.S. has approved a regimen that is critical audit matters, and the EU and the IAASB has used the word key, and the key is, how can I call it? I think you've done well to describe it and what it is, although it's kind of left a little bit open. And so I will, let me talk a little bit about that. The first thing I want to say is that the question of extended audit reports, from my memory, goes back to basically Enron's failure. And Joe Berardino, who was the CEO of Anderson at the time, wrote an op-ed piece saying that he thought that the audit opinion needed to be expanded. More information needed to be provided. And in fact, Sam DiPiazza, who was the CEO of PwC, wrote a book on how the audit opinion needed to be expanded. Much more information needed to be provided. And so that was kind of in some ways, kind of the crystallization of that. And of course, if you're kind of as an academic, you're, a little curiosity. I've always wondered, and I'm sure you would wonder, like, what would the Enron CAM have looked like? What would that kind of, like when they did the risk, would the CAM have said something like, the company, the risk is that the company has created 2,500 special purpose entities, one of the reasons of which is to transfer $25 billion of debt off the balance sheet, and for the most part they're affiliated by every kind of, like I'm thinking to myself, okay, what would that CAM, maybe multiple CAMs. I'd love to see somebody take on that challenge. If you like, what would the Enron CAMs have been? And then, of course, what would the effect have been? CAMs are obviously in their infancy. Personally, I think they're great. Who wouldn't think they're great? Okay, if I put on my lawyer glasses, I would think they're really great. I really want CAMs, because the truth of the matter is that, well, it's just one of those truths about if you give more information, then you expose yourself more. Your audit, that is. So the question for me becomes, with a CAM, is how do we relate that to the core mission of a professional auditor? And what responsibilities does that do? For example, I have up here a discussion about is the ear primarily education, or is it reliance or assurance? Are we educating people about information about the company, about the audit process, or are we providing them with assurance? And I wonder whether or not, when I look at what the PCOB is talking about, I wonder, and I read, and I've looked at the CAMs and what the for example, the IAASB and the FRC are promoting. I wonder whether it's the same. I just, is it education or reliance, or is it something, a hybrid? Does it matter? And it seems to me that what a CAM, whether it's a K or a C, has to do is it has to disclose those things that could cause a material misstatement in the financial reports. And that could come from any reason, complexities, standards, even the business itself. So I think that's one question that we're going to see. As I said, it's kind of in its infancy. Now, when I put my lawyer hat back on, my lawyer glasses, okay, you step into a courtroom and you put your hand on, well, maybe the Bible these days, maybe something else, I don't know. And you say, the truth, the whole truth, and nothing but the truth. That's the testimony you're going to give. And each one of those things is different. And anyone who has children know they're different. So I wonder or worry that an ear is presenting something, can be made to present something that's only one of these prongs. It represents the truth, but it's not the whole truth. Or it represents the truth, but it's not nothing but the truth. There's more in there that shouldn't be in there. There's stuff that's missing, or it doesn't quite reflect the true nature of the actual economic activity that you're trying to present. Now, I thought it was very interesting this past week that the Rolls-Royce ears and its extended audit report were, I guess, it was reported that they're going to be taking another, so the regulator's going to take another look at the Rolls-Royce CAM. Now, this is the award-winning CAM, and there's an issue that came up. Maybe there are multiple issues, I don't know, but there was an issue that came up about contingent liabilities and the nature of the, I guess it's a fraud, the assertion or the deferred prosecution agreement that says, basically that says, and I guess don't quote me, but that says that basically Rolls-Royce was a serial briber of personnel around the globe. Now, putting aside whether or not that's necessary to do business or any of that stuff, and that the question became, did the CAM properly reflect that? Now, when I talk about this, I don't, like, I'm not a, before I went to PwC, I actually started at KPMG, and they're clients of ours, and I say this with a kind of a measure of affection. It's not meant to be a critique. But I wonder whether this isn't a great kind of learning opportunity for CAMs. Like when we talk about CAMs as infancy, here we have the poster child for a good CAM, and then we have the next step, which is, okay, well, maybe we need to take a look at this again. So that was kind of one of the things that I wanted to talk about. Now, some of the issues that I've identified up there on the Rolls-Royce discussion of the CAMs was, do we need to be careful not to add information that seems to indicate a bias in management's favor? Are you reporting what management wants in your CAM? Explanative. Obviously, CAMs provide lawyers with huge Monday morning, we call it Monday morning quarterbacking. I don't know what you guys call it, Monday morning, what, soccer critique or something like that. that's just the truth of the matter. That's how it works. That's how liability works. Of course, the other aspect of this here is that, like, a going concern opinion is an incredibly difficult thing to discuss, but because if you raise it in an opinion, it can create the very thing that you're worried about. Well, can an ear do the same? And then if you're referencing other things in your CAM, the audit committee report, expanding disclosures, kind of other things, then are you giving an assurance level of those? So those things that I think we're going to see this more and more, these discussion happen more and more, and it's going to be interesting to see how it plays out. Now I have another point here, which is key versus critical. Does the language matter? I'm sure Marcus has had this question multiple times and dealt with the PCOB probably in different meetings and all that kind of stuff. I get it. But for a layperson, just kind of observing it, you know, I think of key as, it's kind of educational, or like in audit, revenue recognition is always key. It may not be critical, but it's always key. Well, it might be key and not critical, and I know that the recommendations have been, well, pick the thing that's more important as a key audit matter, which I guess takes you towards critical, but I'm not sure. I don't really get it. Critical seems to educate about the reliability of audited results. And it may well be that the PCOB and the IAASB are focused on different objectives here, but we'll figure that out as it goes. Now, this is some more questions that I have. We have a new thing in the world of auditing, which is regulatory agencies that examine audits. And I have a question, which is, okay, does this mean that we could end up with restatements of CAMs? Like an audit firm puts out its extended audit report and it has to restate that because a regulatory exam comes in and says, well, that wasn't correct. So that becomes the kind of a question. I don't know the answer to that question. Will the regulators target CAMs for particular examinations? Like just, okay, CAM number 3, we want to examine that. It could well happen. I don't know. Because the regulatory regime is different in the different countries, what's going to be the response to that? One of the classic things is a CAM considered new information, additional information that could be covered under the various legal acts. David, let me know if I'm running too long here. Okay. Now there's a paper on SSRM from Michael Pikulik, and I might have drawn this. This might be a previous version of it, so if you're interested. I thought Michael does a lot of accounting ethics work and accounting ethics writings. In fact, we've co-authored several books on the topic. And he wrote this about the Rolls-Royce CAM. Again, not as a kind of, I want to reiterate, not as a statement that KPMG did anything wrong, just kind of raising questions. So this was what was written in the CAM, and it talks about the risk. And it talks about, a large part of the group's business is characterized by competition for individually significant contracts with customers which are often directly or indirectly associated with governments, and the award of individually significant contracts to suppliers. And then the procurement process associated with these activities are highly susceptible to risk of corruption. And then at the bottom, they identified that the Serious Fraud Office has an investigation, and breaches of laws and regulations can lead to fines, penalties, criminal prosecution, et cetera. This is a pretty significant disclosure in an audit report. And what Michael Pekalik was asking was, I thought it was fair to ask. He said, rather, in this case, shouldn't there be a discussion about the risk of material misstatement from the company's failure to account correctly for bribes, i.e., including them improperly in operating expenses? The risk of material weakness in internal controls, which is implied by bribes. The risk of the companies not recognizing and disclosing properly the possible outflow of assets from adverse legal decisions. That's a very different perspective, and I think that there's a lot of research opportunities here for looking at what was said, what could be said. This was another aspect, and he said, and I'll skip, they refer to disclosures in Note 23. Does that mean they're agreeing to Note 23? Financial statements reflect appropriately the matters required to be disclosed by accounting standards. And then Michael says, should there be a statement that says, the estimated liability, the estimated disclosure in these contingent liabilities is something north of whatever, as opposed to what was said. All right, so I'm done, I think, yeah, okay. One last thing, just for, again, kind of a little bit more education about the CAMs. We just looked at a random sample of 31 FTSE 100 companies, 99 CAMs, and we just looked at increase in word count. Are we getting longer or shorter? And I just thought that was an interesting, again, a kind of a research. Are we going to end up with much longer CAMs, as I think Marek would say we don't really want, but don't let me put words in your mouth. Or are we going to kind of have this other, what I call judgment-laden CAM disclosures. So anyway, so that was my dual presentation on trends and CAMs, and I hope that we can get to some questions on how the research opportunities exist here.
Okay, our final speaker is Onion, and he will speak to us for about 15 minutes, and then we'll have some Q&A.
Well, as mentioned before, I'm from the Netherlands. And the Netherlands is currently, I think, an interesting environment to do research in. One of the reasons is that in the Netherlands we implemented quite a few measures ahead of the troops. We implemented mandatory firm rotation already. We have quite strict separation between audit and non-audit services for PIs. And also, as was mentioned, we implemented the extended audit report earlier, and it was implemented in 2014 already. That's one reason. The other reason is that we founded the Foundation for Auditing Research 1.5 years ago. Basically, the Dutch audit firms committing themselves to providing funding, but also data for academic research into audit quality. So if you have an interesting research question, but have never been able to get the data, make sure you go to the website of the Foundation for Auditing Research. If you submit an interesting proposal, then actually the foundation is going to collect the data for you, which I think is an appealing thing. Now looking into the extended auditors report. In the Netherlands we had a pilot in 2013. It was mandatory as of 2014. And that was in response to quite some debate in the Netherlands about audit quality. And the audit profession responding to that. Stakeholders asking for more information, more specific information. One of those stakeholders, Eumedion, representing the the larger institutional investors complaining about the fact that, for example, the auditor's report of the largest bank in the Netherlands was exactly the same as the one for the smallest retailer, right? So does that make sense, or should there be a difference? It was implemented in 2014, and it was not only this that was implemented, but at the same time there was the requirement to actively present at the shareholders meeting of listed companies. So those two together should make sure that there is more interaction with stakeholders, more discussion about what is the auditor doing, what were the findings, what are we actually relying on, right? Auditors generally, they make the newspaper headings for things that they didn't do, right? Complaints about auditors not doing a good job. So if that's what ends in the newspapers, and other than that you never communicate about what you do, how can you expect people to understand what you do and to trust you? You can't, right? So if you want stakeholders to rely on your work, if you want stakeholders to trust you, you should explain what you do. And the extended auditor's report, in combination with active presentation at the shareholders meetings and also answering questions at those meetings, that should be a step that helps in gaining trust. Now, we now have 2 or 3 years experience in the Netherlands, so the opportunity to do some research about the extended auditor's reports, about the effects of the extended auditor's reports. And a research that we did last year is about the interaction between the financial statements, the director's report, and the extended auditor's report. It was already mentioned. Should there be more information in the auditor's report than in the financial statements? If, as the auditor, you state that the financial statements give a true and fair view, then the financial statements should have all the information necessary to understand the results, the financial positions and everything. So there shouldn't be a need to put more information in the auditor's report to make people understand the numbers. Right? If that would be necessary, then basically the conclusion should be that the financial statements themselves are not complete. The auditor's report should basically be about the audit. What did the auditor do to address the key risks? In our research, we did find that in certain cases, actually the auditor's report contained more information about a certain item than the financial statements themselves. So that's one side. Then if we look at 2 relevant aspects in the financial statements and director's report, starting with the financial statements. Companies need to disclose their key judgments and key estimates. And if the key audit matter is about a balance sheet item or an income statement item, you would expect that it is about something for which estimates need to be made, difficult judgments, right? That is then key for the audit. So generally you would expect that if there is a key audit matter about the financial statements item, that there is an extensive disclosure about that in the financial statements, because you would expect it to be a key estimate or a key judgment. On the other hand, if there is a key audit matter, or if there is a key estimate or a key judgment, the question is, should it be a key audit matter? Would we understand that something is very key according to the company, but that the auditor does not believe it's key? The same for the risks. The company is reporting risks, and the auditor is addressing risks in the audit. Different types of risks maybe, right? Not all risks for the company, which may be business risks, are also audit risks. But to a certain extent you would expect a link. Right? If it is a risk being mentioned in the auditor's report, you would expect that it is a risk that also the company has identified and reports on in the director's report. So you would expect some interaction. And the effect may be twofold. One is that, there has been research before, we do see that there are companies that report a lot of risks. Right? 20, 30 risks. Sometimes even 20 or 30 pages of risks. So there have been complaints about the large number of risks, which basically make the risk paragraph relatively irrelevant. to a lesser extent, that also applies to the key estimates and judgments. There are companies that have up to 10 key estimates in their financial statements. In those cases, maybe for the user, it's relevant to understand which of those key estimates are really key according to the auditor. That may help also focus the reader's attention to what is really key. On the other hand, the fact that the auditor reports to the company that he is going to report a key audit matter on a certain item, that may also persuade the company to be more transparent about that item. So the interaction may go in two directions. And that is what we have investigated. What was the result of that in the first 2 years? And it may be interesting to see how that develops over time. What do we find? We did find that the link between the estimates and judgments and the CAMs is pretty strong. A lot of the CAMs are about key estimates and judgments. And I'll show some details on the next slide. The link between risks and CAMs is relatively weak. The results indicate that basically the auditor is selecting the key audit matters from the balance sheet. And what are the most material items, for which items is the most difficult judgment or estimate necessary, and that basically drives the reporting of key audit matters. If you look at risks, there's little evidence that the auditor is focusing on risks, and based on those risks identifies the key audit matters. I'll come back to that as well. I think linked to that, there are very few risks about internal control, very few CAMs about internal control. And there have been some complaints about it in the Netherlands from stakeholders. Now, those stakeholders say we are actually most interested in those internal controls. IT, cybersecurity, new EU regulation about identity. What are the risks in those areas? And did they properly address those risks? And did the auditor look at that? That is where a lot of stakeholders complain that they believe that the auditor stays on the safe side. Right? They complain that, yes, we do know that probably the goodwill impairment test got your attention. We believe you, you actually don't have to tell us that. We want to know what's going on in the internal controls and how you looked at that and what your findings were in that area. Very limited number ending up in CAMs. Some CAMs are entity specific. There is a lot of improvement that can be made in that area. Some very good examples, but we also have still a few boilerplate ones. I will give an example, at least of a good example. And interesting, if you see at the discussions that we have nowadays about non-financial information, the relevance of non-financial information, the increased role of the auditor with regards to the director's report, and the development of, for example, integrated reporting. Wouldn't we expect that in the coming years, the auditor starts reporting more and more on that side of the information? Why was the environmental information, the sustainability information in the director's report, or the customer satisfaction information, or other non-financial information not key to the audit? So far we hardly see them. But given the development that we see in relation to the relevance of financial versus non-financial information, I think there is a challenge for auditors to step up in that area. Now, to give you some details behind these findings. On the left are the results from the Netherlands. I also added on the right results in the UK. And there you clearly see that on top of the list of key audit matters, it's all related to balance sheet items, some P&L items, and mainly about estimates and judgments involved. Tax accounting, uncertain tax positions, and the valuation of deferred tax assets. I think like 75% of the companies, or companies have an auditor's report that reports this as a key audit matter. Goodwill and goodwill impairment testing, revenue recognition, business combinations, assets held for sale. It's a lot about accounting, actually. That's the starting point for the key audit matter. It seems that the accounting drives the key audit matters more than the audit. And then, of course, the auditor starts explaining what he did to audit this. If we then go to risks, there you do see that of all the risks reported by companies, only 10% ended up in a key audit matter. And that's mainly driven by the risks that were reported about income taxes. So also there, you could even question whether it was the risk that drove it or just the deferred tax asset, which was large and had some uncertainty. And if you go through the risks that companies report, there are a few where you can understand that the auditor would say, well, this is not really key for my audit. But almost any company reports a risk about compliance with law and regulation. Now, we just had the Rolls-Royce example as well, about bribery. Compliance with law and regulation is key for almost every company. They all report a significant risk in relation to that. We didn't see any auditor reporting a CAM because this was key for the audit. And if we then see that, if you look at expectation gap and what stakeholders expect from auditors, they expect auditors to detect some frauds. Right? It has everything to do with compliance with law and regulation. Going concern is another area where stakeholders expect auditors to step up and improve better than they have been doing before. Also there, financing, refinancing, a lot of companies report it as a risk. And it doesn't end up in a key audit matter. There are some other examples as well. Now, IT and internal control, it's a significant risk reported by many companies, but hardly any auditors. So yes, the auditor's reports are relevant, and it's relevant to understand what the auditor has been doing about goodwill impairment testing and deferred tax asset valuation. But if we want to go to the next level, I think auditors need to start reporting on these kind of aspects as well. What did they actually do about the IT and the internal controls and the compliance with laws and regulations? Quickly going through a few best practices. Also maybe underpinning my statements before. This is a key audit matter about goodwill impairment testing. And we do see quite a few key audit matters where the auditor says, well, goodwill impairment testing was key, and we looked at the assumptions and etc., etc. How relevant is that? As the Dutch institutional investor said, of course we expect you to look at the goodwill impairment test. This is an example of a key audit matter where the auditor says, I specifically looked at the goodwill in Brazil in my turnkey segment. That's a specific key audit matter. It's not necessarily all the goodwill and all the goodwill impairment testing that was key. No, it was for some specific segment or in a specific country where the headroom is low. That is where it was key. And this is about an entity-specific key audit matter. If you come from the Netherlands, you don't see the company name, you read the key audit matter and you know which company it is. That's an entity-specific key audit matter. There was actually one key audit matter in the Netherlands about the sustainability information. So where the auditor did really report about the sustainability information in the director's report. And if we really believe as auditors that that's the future direction of reporting and auditing, we should lead by example and also start showing that we find it important. And this is an auditor that actually did that. What else? One of the few examples where the auditor really reports about the internal control, right, where he does say that there were control deficiencies, segregation of duty conflicts, and how we address that. And it's hard to believe that in 95% of the companies there are no segregation of duty conflicts. There is nothing to improve in the IT, and that it didn't require your attention as an auditor. And this comes back to the link that I described previously. There are a few good examples where you do see that the auditor explicitly refers to the significant estimate section, where the auditor describes this is, according to us, a key estimate, and indeed the company itself is having a detailed disclosure about the estimate, and I'm referring to that. And something that we don't have as a requirement in the Netherlands, but that was developed in the UK, which I find a best practice, and I hope that at some point in time it will be adopted in the entire EU, that is the requirement for the audit committee to reflect on this. Now, the audit committee basically supervising the company's management, but also having the role to supervise the auditor's work, saying, okay, I read this in the financial statements, this is what the auditors reported, we had the discussion with management and the auditor, and yes, we do agree that these, in this case, it's about revenue, taxes, direct taxes and indirect taxes, and then the audit committee reflecting on that. And then you do see that there is a real link, and that the audit work provides extra information about what the company already reports about the item itself. I hope that we're going to see this more often. In most countries, for the time being, voluntarily. I think it should at some point in time end up in a requirement. Now, to conclude on this, I think it's a very good first step. And as mentioned, there is not a lot of rules about this, which is good. We can develop this, we can improve this. Few good steps were taken, and it is also meant to have the discussion with stakeholders. So now that the discussion should take place, we should learn from the experiences and step up to the next level, I think. Thank you.
Thank you very much. There's coffee shortly, but I thought we would take some Q&A, so perhaps we'll run a couple of minutes over, just so that we get an opportunity to get some further insight. So is there any questions in the audience that people would like to raise? We've got a microphone roaming, so... Yeah. Gentleman over on the other side.
Yes, Kees Kamferman, the Netherlands. It's very interesting presentations, and I can feel the sympathy all of you have for the idea of the extended auditor's report, and I can think along with you. But listening to you, I can't help thinking that in the long run, this must be incompatible with maintaining the traditional binary audit opinion. If you think in terms of a regression equation, if I may, on the left-hand side, you have a variable with zero variation because basically all companies get a clean opinion. And on the right-hand side, you have an increasing amount of enormous variation in entity-specific information. And at some point, the public will ask, how is it possible that all of this translates for all companies in the same opinion?
Who would like to address that? All right.
I think they're different things. I think it sort of plays to some of the questions that Mark asked as well, actually, about the role of EARs, education or assurance. And I think the way we have seen the CAMs in particular is that they are providing information about the audit. As soon as you ask, what information can I give about the audit beyond the binary opinion, you can't help but talk about the company. It's impossible. And in fact, most specifically, you can't help talking about the company's financial information. So the insight you give, I quite liked this word that was used about it. It gives the auditors colour on that information. So yes, there is a clear opinion, and that opinion covers the whole set of the information. That is the only assurance, per se, in terms of an assurance engagement, a very specific thing, i.e. something that the auditing standards require. If you think of that as a big A assurance, there's a little a assurance that comes from all sorts of things. So people take that assurance from the fact that they have confidence that the audit's been done well. And it's that colour that the auditor is giving through the CAMs. I don't think they're incompatible. I think it's important to recognise what you get from each and why they're different. But I certainly understand why people ask that question, and I'm not sure that it's easy to see that unless we're clear that it's about, that what the CAM is about, as Arjan was saying too. It's really about the audit. It's not about the financial information per se. But you try writing something about the audit, which is all about the financial information, without mentioning it.
If I can just add, back in 2005, 2006, the global CEOs of the 6 networks actually published a vision statement, and in that they questioned the value of the binary on-off good, bad audit opinion. It's too black and white, and they were suggesting maybe we should have sort of 50 shades of grey in between. Sorry. They then went around the world to sound out opinion to that vision statement. And there was a mixed reaction to having something other than a binary opinion. And then, of course, we got caught up by the financial crisis and things went slightly pear-shaped. But it was something that was considered by the firms. I would urge you to review and read the vision statement of the 6 firms. It's quite interesting.
Can I add to that? I think there's one area where I would expect this, or hope maybe, this to change first, and that's about going concern. Right, where I find the on-offs, where it's either you're bankrupt or you're healthy, sort of. Now that's just not reflecting reality, right? There you really have 50 shades of grey, and there is debate about, should going concern be a standard item in the opinion, or should it be on an exception basis? I hope that will develop in a situation where a company needs to report in detail about its going concern assessment. In the UK we see that with the viability statement, and then the auditor reporting on that, because it's just not that simple that you're either bankrupt or healthy. There are so many variations there. I think we should get rid of just the yes or no answer.
Another question perhaps. Just if I may, the litigation issue around these key audit matters, if an auditor doesn't include an important item, and perhaps Rolls-Royce is the example of this, is this creating higher litigation risk for auditors, or is there a way of mitigating that risk?
Personally, I don't think so. Whether you have an extended auditor's report, yes or no, if there is an issue at a company and you didn't do a proper audit, you will be sued for that, right? So it's about the work that you've done, and whether you can show that you properly address the matter in your audit. That's relevant. And if you can't show that, you have litigation risk. I don't think that the extended auditor's report as such add to that risk.
Let me just add to that I think the answer to that question is going to depend on a country-by-country basis. Certainly in the US, the introduction of critical audit matters is going to play its way out through the federal courts. Invariably, there's another Enron or something like it that's going to come along. You can guarantee that. Maybe a whole bunch of them. And I wouldn't be at all surprised if some of the federal courts cases that are going to be decided in the U.S., this will play out through the next several decades. So I guess we'll find out would be the answer to that question. Time
is against us, so I think we'll draw it to a close. But I just want to thank each speaker Jeremy started us off with some challenges really about some of the changes that we're seeing and whether they are in fact useful, the auditor rotation, for example. And there are clear research opportunities here from an academic perspective to look at that. We then heard about some of the really good things happening in audit, and particularly from the regulatory perspective, and the feedback loops that they were getting to make sure that the transition to this new report was a good one. And again, how they went to those stakeholders and got that information is important. But it seems to me there's still big questions about the usefulness of these reports going forward is an academic question that we can help the debate. Mark then really challenged us around some of the ethics that can occur in these debates, and Rolls-Royce is the current example of this, where it was the exemplar and then suddenly we're going to have another look at that to see what might have gone wrong. I know KPMG is saying that will stand scrutiny and the like, and we hope that's the case. But it's a learning, and I think I heard from the panellists that this is the beginning of a journey, not the end of the journey. And so we need, as academics, to be asking, how is this working? And we can help, I think, there. And then our last speaker gave us some very good insights about what's actually happening in practice. And the Dutch have moved to this a little bit earlier, so we've already got some early evidence about where these key audit matters are lying, the type of disclosures are being made, whether we're seeing boilerplate. And in fact, I know there will be a debate about whether boilerplate is better, and there's another academic question there. So I think we've got some very interesting research opportunities, and I just want to reiterate that the Dutch appears, and I wrote it down, they have a whole research agenda that they're willing to help academics. Now this has been one of the biggest problems for academics to get the data, and here is an opportunity for the Dutch to help us get better data, and I challenge my colleagues on my right, to open those doors in the other jurisdictions. There's a lot of data being collected, but we can't get access to it often, and I was really impressed with what the Dutch are doing here. So it's been a fascinating hour and a half, or a little over. Let's just thank our speakers once more for a very good presentation.